Let's get back to Fed Chairman Ben Bernanke's testimony up on the Hill today and really what it suggests for the overall economy, Fed policy, and also the bond market. Joining us right now to talk about all of this, Ward McCarthy, chief financial economist at Jefferies Co. Bloomberg ranks him, by the way, among the most accurate economic forecasters for data on personal spending and housing starts. So a great person to have here. Ward, great to have you back.
Well, thank you. It's nice to be here.
You know, we just did a roundtable with Mike McKee and Peter Cook, and, you know, net, the feeling is that not much has changed in terms of what we're hearing from the Fed. How about you? Did you feel like we got anything significantly different today?
Well, it was subtle and nuanced. I mean, there is a slight change here. He's a little bit more optimistic, but he's reluctant to get too optimistic. But I do think he has a pretty good pulse on what's going on in the economy. The other thing I thought he did well was put the rise in commodity prices, and specifically oil prices, into in a context that's appropriate for the U.S. And in so, I think perhaps maybe addressed a public relations problem that the Fed has right now on inflation.
Meaning what, specifically?
Well, the biggest thing is the U.S. is not as commodity-based as a lot of these other countries overseas that are having significant inflation problems, especially over in Asia.
Right.
We're much more a service-oriented economy. So, yes, it's going to affect us. And sure, anybody who drives to the gas station on the way to the food store over the last 6 weeks is thinking, wow, prices are going up. But the Fed looks at core inflation.
But are they right in doing that? You know the debate. We all talk about it's costing me more to fill up my tank. It's costing me more to put cereal on the table and whatever, you know, what have you. I mean, is it right to keep focusing on core inflation? Well,
they'll do that only to a certain point. I mean, the first thing I think that matters here is that the rise in oil prices is initially probably going to have an effect on the composition of consumer spending.
Right.
People are putting more money in the gas tanks, so that means they can spend less on other things. So he's right that there could be an adverse effect on growth. But if you look at the history of commodity prices, they tend to be significantly more volatile than other prices. And so he's going to sit back for a while and make sure that it doesn't spread to the general price level.
What do you think, though, about the consumer? We talked about how you're a Bloomberg best in terms of personal spending. In terms of what we're seeing for personal spending trends and really what we're seeing among the consumer, do you feel confident about the outlook here?
Well, I feel confident, but I don't think we're going to have a robust outlook. And consumers came back to life in the fourth quarter, and I think that was a good sign that they were, you know, having a sigh of relief. But going forward, consumer spending is pretty much going to track job growth. So we really need to see a significant improvement in the labor market if we're going to see a significant improvement in consumer spending.
You know, we're talking about consumers. I want to bring in, we had Martin Feldstein on earlier. He's the former president of the National Bureau of Economic Research. These are the guys who declare, you know, when a recession ends and starts. He talked about growth. Let me just bring this in for everybody.
This is not a strong economy. There hasn't been the pull-through from the fourth quarter to the first quarter.
And we should remind everybody that he was part of the NBER committee that declared that the recession ended back in June of 2009. Do you agree with his assessment of the economy?
Well, yes, I do. And the point is here that we still have a legacy from the prior recession. And we saw this in the fourth quarter of last year, is that state and local government spending ended up being a drag on GDP, and that's going to continue for a period of time. We also, this is the first recovery that I can recall that construction has added nothing to GDP growth. And that's probably going to continue for another couple of years, given the state of the residential market.
So given the state of that, then what does the Fed do come June 2011? Can they be done with QE?
Oh, I think they can be, and I think they will be. I think what Bernanke was telling us today is that he thinks they've poured enough gasoline in the carburetor that it's going to catch, even though we're maybe only on 4.5 out of the 6 cylinders or something at this
And that's
point.
okay? We can catch up? We can catch on, if you will, and continue the growth?
Well, yeah, I think so. But I think it's going to take time. Again, the key things here are we need job growth and we need housing to recover. Once that's happened, then we can have robust economic growth. But it's probably not going to happen unless we have more time to pass for these things to recover.
I say this a lot. I mean, so the question is at this point, just be patient. Let the cycle run its course. I mean, it sounds so boring. It sounds kind of so lame, but that's kind of what we need to let happen here.
Well, that is what we need to let happen. But tell that to the over 7 million people who still don't have their jobs. They lost them in the recession. And, you know, it becomes more than just looking at numbers.
Okay. We've got day 2 of Ben Bernanke tomorrow, so we'll see what else he has to say then. Ward, always good to get some time. Thank you.
Thank you.
We appreciate it. Ward McCarthy, everybody, chief financial economist over at Jefferies & Company.